everybody, I'm John VANDUZER, CPA and partner with James Moore Company, and I'm joined by Elena Davis and Daniel ROCCANTI and for another episode of our weekly Tax Biden update. If you haven't already, check out our website and our YouTube page for past episodes, and you'll definitely find a lot of good information there, and we'll continue this update weekly. Last week, we talked about what planning you can do in the meantime while we're waiting on the final legislation to be passed. So there's definitely some good information there and definitely some good food for thought on what you can do before the bill is actually passed. To give a quick congressional update this past week, it was a holiday weekend, so not a whole lot happened. The House did approve, as recently as a day or two ago, the extension of the debt ceiling. So this avoids any sort of shutdown or showdown through December. So that won't be used as a bargaining chip to jam any legislation through. On the actual $3 trillion infrastructure package, which is what is the tax increases are buried in, on the revenue side, there's a lot of speculation that the bill is going to have to come down. It's probably, the $1 to $2 trillion price tag is what a lot of people are speculating that Congress could actually pass. So on the spending side, they're working on getting that down, and there's a lot of different speculation on how they're going to do that. But then on the revenue side, they're also saying, hey, if they're not spending as much, they probably don't need to raise as much. So there was even an article in Politico, and the headline is Democrats likely to throw billions in tax hikes overboard as spending plans shrink. And so when you go through that article, it basically says, hey, if we only got to get to like $1.5 trillion, there's only about 4 or 5 of these provisions we need to get to the number to balance out. And all these others aren't necessary. So it'll be really interesting to see as this progresses and maybe the spending gets tapered back, what provisions ultimately make it in the bill, and then what things are more pie in the sky in nature that get kind of put to the side as they don't need it and can't get it through Congress. So there's the update. Like I said, not a whole lot happened, and we'll continue to watch it every week. One of the areas that we haven't really delved much into in the bill is this requirement for banks to report certain bank account activities. So Daniel, why don't you give us kind of a quick update on what that provision is and how it would affect you?
So yeah, there's been a lot of talk recently about basically unreported income not being taxed. And so Congress and IRS have been trying to discuss ways to basically help compliance so that that gap closes. Because I think the IRS commissioner a couple months ago said that he thinks the gap is all the way up to $1 trillion every year. So one of the ways they've discussed is by making banks required to report all bank accounts that have transactions of $600 or more in a year. So kind of how like a 1099 has to be issued if you receive $600 or more, this is just any transactions in your bank account. And they're kind of hoping this will close the gap because compliance is pretty high for like W-2, but if you have a business or self-employed income, compliance is a lot more difficult, and they're hoping that this will help close the gap for those people where they feel like most of that $1 trillion that's missing every year is probably coming from. There's been talks about maybe increasing that to about $10,000, but that's come with a lot of criticism lately. But there could be major issues here, and I think, Elena, you probably have some opinions about that.
Yes, Daniel. Of course, from compliance standpoint, this presents a whole slew of issues. For example, there are a lot of instances where income does not necessarily mean cash. They're not equal. What do we do with instances where individuals transfer money between their own bank accounts? The businesses who use loans to make purchases and later take depreciation. The, various differences between accrual and cash accounting, any kind of intercompany transactions, and flow-through taxations where shareholders and partners take distributions that are clearly not taxable income but will show up on the bank account. So there are numerous transactions that will be reported on these 1099s that are not actually income, taxable income. Of course, banks and credit unions and any other financial institutions highly opposing this proposal because that will create unnecessarily burden trying to track all these transactions and provide the forms to the IRS and the individuals. And to top it all off, it is very unclear right now what the IRS is actually going to do with all this information. Is it going to just be used as a red flag in their system to possibly increase the number of audits? Is it going to be just automatically applied as a matching mechanism? Like currently, they're matching the W-2 copies that the taxpayers receive, that the IRS receives the same copies. The IRS receives copies of the 1099. So there is already a matching mechanism going on. Will that be an additional form that is being automatically matched? That is uncertain. But if you recall from our prior episodes, there is a proposal to give the IRS more funds. So perhaps the IRS will have the ability to conduct more audits. We'll just have to see.
Yeah. And this is a big area, and there's been a lot of articles and headlines out about this in the last few weeks, especially as they're kicking around, well, is $600 the right limit, or is $10,000 the right limit? There's a lot of cynicism that says, even if you have a part-time job, you'll make $10,000 in a year, so that still affects everyone. So it would definitely encourage you to reach out to your banks and your credit unions and get their position on this legislation and see how you can help them as we're going forward, because this is a huge burden. This would be a huge burden on the banks and the credit unions, as they would have to have that reporting infrastructure. And honestly, it would be a huge burden for our accounting firm if we had to provide these reconciliations and do this. It would be a lot more work. It would be the cost of tax compliance would be higher in this country, having to account for all of these things, especially when there's a whole lot of areas where cash by design won't match your income. And so it's something that we're definitely watching and monitoring and want to make you all aware of. So that's all the time that we have today. It's very brief, but we'll continue to watch legislation as it unfolds and continue to highlight various areas of legislation. So be sure to check us out next week. Thanks, guys.